Welcome back to our real estate valuation series. In our last video, we explored the income valuation approach. Today, we're diving into the big leagues with the DCF valuation approach, a favorite among institutional investors. In simple terms, the DCF approach is like looking into a crystal ball to see the future profitability of a property. It's a powerful way to value commercial real estate by looking at the present value of future cash flows. Unlike the income capitalization approach, which uses a straightforward cap rate to determine value, DCF goes deeper. It starts with the net operating income from the property, but then goes further by calculating the after-tax free cash flow years into the future. It incorporates all financial aspects, from interest and debt payments to taxes to capital expenditures. All are considered, leaving no room for surprises. Think about it like this. The income capitalization approach and sales comparison approach are like taking a snapshot of a property's value at a specific point in time. They're good for understanding the market value today based on current market conditions, but they don't tell you much about how that value might change in the future. The DCF approach, on the other hand, is like watching a movie about the property's financial future. It allows an analyst to understand the value of the property over the entire expected holding period, based on the expected changes in market conditions. This method is especially useful for institutional investors who leverage their acquisitions, as it helps determine whether the property's cash flow can cover all financial commitments and still generate an acceptable return for equity holders. Now let's talk about a crucial element of the DCF method, the discount rate. The discount rate is the return that investors expect to earn on their investment, considering the risk involved with the property. It's similar to the cap rate used in the income capitalization approach, which also reflects the investor's expected return. However, there are key differences. The cap rate is based on current market conditions and looks at just 1 year's net operating income, while the discount rate in DCF considers all future cash flows and brings them back to their present value. The discount rate reflects the required rate of return, accounting for both opportunity cost and risk, to ensure investors are appropriately compensated. Additionally, the DCF method captures the value of growth by considering expected changes in cash flow over time. This means a property with increasing cash flows will be valued higher than one with steady cash flows, and vice versa. So when should I use DCF over the income capitalization approach? The answer lies in the property's characteristics and your investment goals. DCF is like a powerful engine for complex scenarios. It is flexible and capable of incorporating changing market conditions through detailed forecasting, adjustable discount rates, and scenario analysis. Ideal for properties with long hold periods and growth potential. The income capitalization approach is best for stable net operating income properties, like apartment buildings with long-term leases. But for properties with changing income or expenses, DCF is the way to go. While the DCF valuation approach is incredibly powerful, it's important to remember that it does have limitations. Like any financial model, DCF relies heavily on assumptions about future cash flows and discount rates. Think of it like predicting the weather. You can use sophisticated models and historical data, but there's always a chance of unexpected storms or sunny days that defy the forecast. For example, if you assume unrealistically high rental growth rates or underestimate future expenses, the resulting valuation will be inflated. Consulting with real estate professionals, such as appraisers, brokers, and property managers like our company Al-Baida Real Estate, can provide invaluable insights and help refine your assumptions. While DCF is a powerful tool, it's essential to use it judiciously and with a healthy dose of skepticism. So, that's a wrap on the DCF valuation approach. Hopefully, you found this video helpful in understanding this powerful method. Stay tuned for our next chapter, where we dive deeper into more advanced real estate valuation techniques. Don't forget to subscribe and hit the notification bell so you don't miss out. Happy investing!